media briefing at midday as well. But let's stick with the story. James Gerrish joining us from Shaw and Partners now in Sydney. James, I mean, a shocker for CBA today in terms of this APRA Prudential report. Is this worse, a lot worse than you may have expected? And I guess, you know, coming to the stock market, do you expect to see CBA take a big hit in trade today?
Yeah, good morning to you guys. Obviously, some pretty negative reading, pretty negative headlines. So I think from a attention-grabbing perspective, yeah, it's certainly damning for CBA. In terms of the APRA conditions around increased capital requirements they've put on CBA, an extra $1 billion. It does sound an impressive number. It's probably not as impressive as what it reads. It's about I haven't run the numbers completely through CBA, but I think it'll take about at about 0.25 basis points of required capital for CBA. So it's not huge for CBA. I think the headlines from a political standpoint, and you think about what Scott Morrison is doing and what the Liberal government is doing, they need to go hard on the banks, given that they were reluctant to launch this Royal Commission that's been so damning. So, look, it's a negative headline for CBA. If it comes down on the open today and sharply lower, then it's probably a buy in the vortex of all this negativity.
I mean, understandably, the government looking to be tough on the banks as a consequence is, perhaps some bad look for them when they were quite against the Royal Commission, and obviously the findings out of the Royal Commission have been quite staggering. But is it more of a concern, I would have thought, for the banks, some of the language that APRA is using in terms of its investigation into CBA itself? Because, I mean, this is the prudential regulator. This isn't, a government looking to potentially, ahead of a budget, ahead of election, score some political points. This potentially points to change into the future as far as some of these banks are concerned.
Yeah, it's a regulator. I mean, they've got to go out there and use hard language. There's some pretty serious discussions and accusations being made against the bank. So clearly there needs to be forceful language used. And you made mention of, they've come out today and increased their capital requirements from CBA, which is, that's what they can do, and they have done in this instance. So any increase in capital is obviously a negative for the banks, but it is up to APRA. APRA want a very solid banking system here in Australia. We do have a solid banking system here in Australia. There is some improvement that needs to be made clearly, but around the rhetoric that's coming out, I mean, I understand why it's so forceful and why it needs to be so emotive, but again, you made mention of it's what APRA will do. They've made a determination today on CBA. There'll probably be similar instances in other banks going forward, but it is, that sort of penalty or that sort of change in metrics is still well in the realms of CBA being able to sustain it.
Right, so if we talk about the metrics and what we will see for CBA with this extra $1 billion of capital required, and you look at the other banks, do you expect to see the other banks with similar metrics applied, and will it impact them in a similar way that it will impact CBA, do you think? Who's the most at risk, I guess, going forward?
Yeah, it's hard. It's a hard one to say who's the most at risk, because APRA has singled out CBA in this instance going forward. If you think about CBA's Tier 1 capital, I think they hold around $65 billion worth of Tier 1 capital. That's from the numbers that I understand. So an increase in $1 billion, it is an increase, and it's obviously going to be a negative for their metrics going forward. But it's not a significant impost for CBA, and it won't. It shouldn't really impact whether or not you go in today and buy CBA. I don't think it's material in that regard. CBA is incredibly well capitalised. The banks under APRA's guidance have increased capital substantially. They're now well and truly above where they need to be in terms of Tier 1 capital. So, look, we've got a well capitalised banking system. All of these inquiries, as damning as they are and as concerning as they are, they will work through the issues, and you can see what CBA have said today. They're going to do all they can to appease the regulator going forward. So, look, I'd just encourage people to look further afield in terms of the investment landscape and not get caught up in the short-term emotive headlines that we're seeing at the moment.
So do you subscribe to a view that, ignore that, look at the yield on offer at the moment for the banks, see where they've fallen to already, and whether or not there's much downside risk from here versus the yield on offer at these sorts of prices, and see an opportunity?
Well, I'm always conscious of earnings over and above yield. Yield is just a pass-through, or dividends are just a pass-through of earnings. So you've got to be confident around the earnings numbers that we're seeing on the bank. So if you look at ANZ's result out this morning. You know, they had their first half result and it was broadly in line with expectations. So it was a messy result. They've had a lot of asset sales coming out of Asia, so it was a messy result, but overall it was in line. So EPS around $1.19, $1.18 the market was expecting. Dividend was 80 cents, the market was expecting about that. Net interest margins were a little bit slimmer than the market expectation. But you look at bad debt charges were a lot lower as well. So look, the ANZ result was good, and I think the main thing around bank earnings and bank profitability going forward is around loan growth. So, you know, overall group loan growth in ANZ was 1%, but that also takes into consideration Asia. If we look in Australia, it was 4%, and that drops down to a growth in 4% earnings here in Australia. So loan growth is a critical thing when we're looking at banks' earnings going forward, guys.
Yeah, I mean, obviously loan growth is important. Net interest margin fell 7 basis points to 1.93% from the earlier period. Do you expect to see ANZ, I guess given that it was a slight beat overall, I guess you could say, pretty much in line, how do you expect the share price to respond today?
Yeah, I think it'll be reasonably well supported today. I don't think it'll shoot higher on that result. There's a lot of negativity baked into the cake in terms of the banks right at this point in time, and it's probably warranted. There's no doubt about that it's probably warranted. But as I said before, you look at the earnings growth expectations for the bank; they're low. But on the sector's on 12.5 times earnings. That's incredibly cheap for the banks. They're going to grow earnings at a couple of percent. They're going to cut costs out of the operation, so they're going to have underlying profit growth at 5%. You throw in a 6% dividend yield, and you can get a 10% total return out of the banks going forward. I've always subscribed to buying banks when there's blood on the streets. There's so much negativity about in terms of the banks. Don't forget, CBA was trading near $100 not so long ago on huge expectations built into the price. Now we've got really low expectations built into the price, and I think that's the time to go in and buy the banks, really.
To what extent? I mean, while we're talking about the banks, I mean, it's all about weighting, isn't it? Because I imagine a lot of clients already own the banks. What are they, 25 to 30% of the index? I mean, that, I imagine, in the minds of many is too big a weighting. So, I mean, do you have a preference when it comes to allocation to banks in a portfolio? Yeah,
James, so the big four are 27.7% of the index, or they were the other day. So you're smack on in terms of that. So, I've got a more active bias around when to be in sectors and when not to be in sectors. So right now we've been increasingly going overweight the banks at this point in time. We were underweight the banks a few months ago. We're now overweight the banks. But again, if you go into the back end of May, we'll be trimming off our bank holdings post-dividend. So I think you've got to be active around your allocations. You've got to be active around your allocations, I think, in this market. Overall, resources are incredibly volatile at the moment. There's a lot of confluence of factors impacting what resource stocks do at this point in time as well. So, I've got an active bias. We're overweight banks at the moment, but that's not to say we'll go underweight if they rally from here.
But this is my question. I mean, just to sort of cap off this banks chat, you're overweight banks. So basically the concerns around the banking space that are hitting the market at the moment, hitting maybe global investors that are seeing these headlines around the Royal Commission and then, these app reports and some of the language around that doesn't concern you in terms of the banks being an investment prospect?
Yeah, I mean, we're pricing the here and now. So banks right now are pricing all this vortex of bad news. You can see from yourself, people over-extrapolate what the earnings impacts from banks will be going forward. So, as I said before, the biggest thing that will dictate bank earnings is credit growth. Credit growth is not that strong here in Australia, but banks are priced for it. So it comes down to where they're priced at this point in time. And again, it's an uncomfortable way to invest when you're buying things when there's so much negativity around, and then you're selling things when there's so much positivity around. So, resources at the moment are where the majority of people are investing, are talking about, and the positive undertones for resource earnings are there. We're on the sell side of resources at the moment. They've had a very good run up in share price. I'm concerned that the US dollar is going to rise from here, and that's going to put a downbeat overtone on the resources sector. So, look, I think you've got to invest in areas that are seeing most pain and sort of trim those areas that are highly optimistic at that point in time.
All right. James Gerrish, appreciate your time. Thank you very much for joining us today.
Thanks, guys.
Good to have him back. Let's quickly check in on SPI futures before we take a break. Bit of a read as far as what we can expect at the start, and as has been the case, or ahead of the reset at least. Futures are pointing to a negative start, down 17 points. A little bit of a mixed read in terms of commodities and, of course, a weaker lead from Wall Street.
All right, we're keeping an eye on that reset, of course, in about 40 minutes' time. We will take a break. When we return, the RBA widely expected to leave rates on hold when it meets today. We'll get more with Steve Dooley next.